And we are now joined by DD India business correspondent Ajay Mishra. He joins us from New Delhi, and we are also joined by senior market expert Ajay Bagga. Welcome to you both, gentlemen. Coming to you, Ajay, first, a very basic question, if you can explain to our viewers, what is an emerging market?
So, Tanvi, I think there is no clear definition for emerging market as such, but if you exclude the OECD countries, primarily the emerging market, the whole of the world is considered as emerging market. In the recent case of MSCI, the emerging market index, surprisingly, South Korea is also part of it, which in many cases do not qualify for being an emerging market. But the learned, guest on the show, Mr. Bagga, can can throw some more light on why South Korea is a part of it. But yes, barring OECDs and developed countries, all the other economies are considered as emerging market. But there is no such definition, so as to say, in the economics.
Okay, coming to you, Mr. Bagga, there are various MSCI indices, including the MSCI Emerging Market Investable Market Index. Could you demystify these indices for our viewers? What are they, how are they made, and by whom, and what is their significance?
Yeah, there are various index creators, like there are in India as well, who make the Indian indices. So internationally also, there are 3-4 companies which specialize in creating these indices. What is their job? They analyze the stocks of companies, and then they decide how much weightage will they give to each individual stock, and then they build up the country's weightage. So this MSCI IM index that we are talking about is an emerging markets index. Within that, it's for the investable market. What does that mean? What is the available stock of equities? Basically, what is the free float which is floating every day available for buying or selling? So it's based on that. Now there, what has happened is that over time, China, which peaked in 2008 at about 43% of this index, has come down to about 21.5%, as you mentioned. And India, which used to be at 6%, has come up steadily. And now it has overtaken China at about 22.27%. What is the implication here? Implication is that as the flows come in from foreign funds, they allocate based on these indices because their performance is gauged on versus the performance of these indices. So a lot of the exchange traded fund, the passive money starts allocating based on these indices. That's one good thing. Second, the active managers, again, who are measured, whose performance is measured against these indices, they then have to take an active call on whether they invest in the country or not. What has been happening over the last 3 years, Tanvi, we have seen about 5.5 lakh crores being taken out by foreign investors, while domestic investors have more than made this up by investing nearly 11.5 lakh crores between 2022-23 and 24 calendar year to date, January to August. So 5.5 lakh crores went out by foreign investors. That's largely making India an underweight market. So we should be getting 22% of the allocations of emerging markets, but we are getting a little less than that. Today, the foreign investors holding in our markets has gone down from a peak of 22% 10 years back to 17%. But the good news on that is the domestic investors, both institutional and retail, today are more than the foreign investor. So we have gone up from 17 to 22.5. The FIs have gone down from 22 to 17. And what this implies is that Indians are really gaining from the growth of India. So as our markets are going up, Tanvi, we Indians are benefiting from this growth, both And the biggest beneficiary is the government of India. In 2014, government of India's total market cap, all the shares that the President of India owns in public sector units was hardly 20 lakh crores. That has gone up to 80 lakh crores today. So
Interesting.
the market cap. So the biggest beneficiary has been government of India and then the Indian public at large.
Okay. Coming to the story of the day, Ajay, what is the significance of India now holding the most weightage in this MSCI emerging market investable market index, surpassing even China? What is your assessment about Indian stock market strengths and the Indian economy's strengths?
Tanvi, as Mr. Bagga has pointed out, that there are two main indices of the MSCI emerging market. One is standard and another is IMI. So within that standard, India's weight is 20.79%, while that of China is 23.98%. So the gap of 3.2% is not so much to overcome by the Indian capital market. We are expecting that by end of 2024, this gap of 3.2% will also be bridged by the Indian stock markets, and India will take over China in the standard MSCI EM indices. Coming to the IMI, which comprises small cap also along with the large cap and mid cap, I think the performance of the small cap has been tremendous in the recent past, and we understand that since 2021, the China's weight, which was at 38.7%, is now down to just 21.5%, while India, which was at just 9.2%, in just 3 years, the Indian weightage have gone up to post 20%, which is commendable. So it is the strength of the Indian economy which is leading to this confidence from the Indian investors, and the increasing interest of the household savings coming into the capital market is the main reason why it is being supported by the domestic investors rather than foreign investors. So this is the underlying strength of the Indian economy, which is currently the fastest growing among the emerging markets, and also the clear focus of the government and stability of the policies, and the focus of government in manufacturing sector, particularly in the advanced manufacturing like semiconductor, is building this confidence that in the days to come, like China or maybe unlike China, India will be skill capital, and also focus more and more on the job creation along with the skill development, which will add to the economic value going forward. And this might take this journey of $5 trillion market capitalization forward to the much larger volumes, and you might see the further upgradation of Indian weight in these kind of indices going forward.
Okay, Mr. Ajay Bagga, let's try and understand this. So how far does the resultant expected inflow of $4.5 billion help Indian companies and the Indian economy, and what does it mean for the Indian investor?
It means good news for Indian investors. It is a function of the great performance by the government over the last 10 years. We have moved from a fragile 5 economy to a very attractive economy. Even on the debt side, as your segment in the beginning mentioned, we are expecting $80 billion on the debt side over the next 3 years. And added to that, as the Indian weight, which has been underweight, goes even to equal weight, you can expect substantial inflows. 4.5 is basically based on the little bit of marginal change that has happened, but a lot more has to come in because China has been overweight, and over the last week, 3 very big investment banks have put China down to underweight from overweight. So Chinese market has given no performance for 4 years. 4 years it has been giving negative returns. Last 1 year we have given 28% return. China has given -8% return, August to August. So that is the kind of outperformance India has been giving. More flows come in. Right now the domestic investors have been carrying the burden of the markets and holding it strong. as the firepower from the foreign investors returns, you can imagine what happens to this market, and it helps the economy as well. The other big thing which the government has done in infrastructure terms, we are where China was, say, in 2000. So the amount of 40 lakh crores which has been spent on infrastructure over the last 7 years, that is going to give a very big kicker to the economy. The PLI scheme, indigenization of defense, railways, there were no companies which were listed. Now we have 8, 10 huge railway companies, huge public sector defense giants, which have been listed and which are doing very well and getting huge order books. So overall, we have put the economy on a good manufacturing growth path, a good services, which is now $340 billion of exports in services. All that adds back into a very strong corporate India. And Tanvi, one number I would like to share with you. In 2014, we had gone down to corporate profits to GDP is a marker that foreign investors look at very closely. That had gone down to 2.9%. That is back to 5.2%. So actually, with the GDP doubling over the last 10 years, the corporate profits have tripled. And the share of corporate profits in GDP has gone from 2.9 to 5.2. So you can well imagine the attractiveness of the market. It's not a cheap market. What we call valuations in markets, valuation wise, it is an expensive market. That's what the foreign investors cite as a reason for being underweight. But you have to come where there is growth, where there is quality, where there is good governance and good rule of law. You're getting all that in a country like India with a huge local domestic consumption market. I think that is what is the implication of this number. It is just reflecting all the government efforts, all the dynamism of the Indian corporates, and the great resilience of the Indian retail investor.
Coming to my colleague Ajay, how do you think, what is your assessment, how far have the government policies been responsible in this India moving up in this MSCI EM index?
Well, I think it's a combination of several factors, Tanvi, including the push for the growth as well as the control on the inflation, which is the key policy priority for the government as of now. But look at the budget, which is talking a lot about the employment generation, which seems to be the central priority for the government as of now, where the government is talking about having private companies on board to get the internship, because we are adding 1 crore youth every year to the working population, and unless we give them the quality job and they are not absorbed into the formal economy, it will be very difficult for Indian manufacturing to kickstart and get a great leap from here onwards. So yes, the government policies, whether in terms of supporting the growth or containing inflation, which is a kind of tax on the poor, or the spending on infrastructure, as Mr. Bagga just pointed out, that 11.11 trillion rupees, which is spent for this current fiscal. The focus of the government to not work in the silos, but work ministries under the Gati Shakti program to build the data layers to sensitize the state governments to come forward for a single window system, which Mr. Piyush Goyal yesterday urged the state governments to adopt to attract the FDIs in the long term. So on one hand, I think these economic policies, Tanvi, are attracting the foreign direct investment, which is for the long term, and they are here to stay. It is also the policies of the government which is helping companies enhance their productivity and showing their performance on the capital market. Capital market is just a barometer of the psyche of any economy, and we can see that it's a positive, vibrant psyche all over, and the underlying what you say, the high frequency indicator shows that there is uptick in the railway traffic. The number of passengers on the airport is increasing. We add many more kilometers of roadways every month. And also having a big push on the foreign countries' collaborations. Look at the Prime Minister's recent visit to Brunei, and Singapore, where he has invited
Yeah.
the investors from Singapore to come to India and
And he also
participate in
said
the
that I want
growth
many more
story.
Singapores in the country, right?
Absolutely. I think the Indian story is getting recognized by the foreign investors, and the Indian story is here to stay for long. And I think the bet on India is going to be right for not just the investors, but for the analysts at large, where we could see the skepticism from Moody's and Fitch kind of rating agencies, but now they have also showing their strength, showing their confidence into the Indian economy, and we can see in the recent reports by these credit rating agencies also that.
Okay. Ajay Bhaggaji, what could speed up or hinder the increased representation and weightage of Indian companies in the MSCI indices?
What will speed up is a strong primary market. The way we are getting new listings, that's a very robust market. It's one of the biggest markets in the world now. And domestic flows. Domestic flows, now, Tanvi, we are getting something like 35% of the gross financial savings per year are coming into the capital markets. It's a record number, and that is giving a lot of resilience. Second, what that brings in is that Indians participate in the India growth story. Earlier, the foreigners were getting the benefit of this, and a large portion of the wealth creation was going abroad in terms of foreign investors enjoying it. Now, increasingly, Indian investors are participating in it. Third, we are making companies which are now reaching global scale. So we are attaining scale. And the fourth next step will be Indian companies starting to take over companies globally. That will also happen. We are about 10 years from there, where you will see huge amounts coming in. What can derail this? If the political pressure that comes in on freebies and on distribution, some amount of safety net is good, but you have to also invest for the future. And second is the lack of patriotism. I think that is something. What we do is that we celebrate things that are going down, but we don't celebrate great achievements like this. Like, I think this number is a great thing for an emerging economy like India. I'll give you one small example. Last year, 19 funds were launched, which were emerging markets ex-China. Because what was happening, because China is such a big part of all funds of emerging markets, whenever people wanted to sell China, we used to get selling in India, in other emerging markets. Now fund managers are actually launching funds which are ex-China. 19 last year, this year by August, 19 such funds were launched. So actually, smart money is launching funds which are ex-China, which are not having Chinese participation. That gets missed out. And that is very difficult for the person on the street to understand, for us to reach them that message, that what has happened in the last 10 years in this country is transformative. And if we continue on that, if we can manage 10, 15 more years like this of growing at nominal 10, 11%, real 7% plus, we can become a middle income country. And portions of us, the 1% of India is today French in per capita. 20% of India is equal to Eastern Europe or Southeast Asian countries. But we have 20% of India, which is sub-Saharan Africa. That has to be given a safety net, definitely. But you have to create productive capacity. Then you will have resources to redistribute. If you just redistribute on the present basis, you won't have enough to really go around, and you will have bankrupt state governments, as is happening in few of the state governments. So we should not create a Venezuela or a Zimbabwe in India. We should make it a USA. We should make it an advanced country. We are already fifth biggest economy. Germany and Japan are within striking distance. Another 3 years, we will overtake them, because we are growing at 7%. They are growing at 0.5%. We are going to overtake, we'll be the number third in another 3 to 5 years. That is coming. But the challenges are there, and patriotism, I think, that India first feeling for every single citizen, I think that is something much needed.
Finally, Ajay Bhaggaji, how many years do you see where India can actually overtake China in this MSCI standard index. How do you see India basically faring in these indices over the next few years?
I think next 3 years we'll overtake. Quite easily we'll overtake. We have the performance and we have also got a bigger cachet of companies coming in. You didn't have these railways companies 10 years back. You didn't have a lot of these companies existing even. Now look at the way import substitution is happening. We were the biggest importer in the world of defense. Now the recent last week what the government gave the order of more than 1 lakh crores, 99% is domestic. Imagine the kind of value add. The electronics, we were huge importers, $120 billion of importing happening on electronics. Now we have become exporters. We are the biggest exporters of smartphones. So transformation is happening in this country. Give it 3 years, we will overtake the Chinese portion in MSCI. But taking on China is still a very distant dream. They are $18 trillion. We are at $4 trillion. They are ahead of us by about 20, 25 years. And when China grew, Tanvi, in 2000, there was no China. So the Western Europe and Americans allowed China to grow. Today, when we are trying to do the same rule book, there is a China which is obstructing us at every forum. So it is not easy, but it is doable. And the big thing is, always remember this one number. Average age of India is 27. Average age of China is 40. Average age of Japan is 53. 53 means that you will have so many dependents on each young person. China is growing very fast and India is a very young economy. So this is a challenge, but it is ours to mess up. I think we'll make a great opportunity out of it. 80-90% is the success chance for India really to overtake China in these MSCI indices. That's not a big deal. What we have to shoot for is how do we get to a 10 trillion, 20 trillion economy so we have widespread prosperity in India.
Widespread prosperity. And Ajay, any summing up thoughts that you would want to add to this thought?
I think the expert comment should come from Mr. Bagga that this kind of news should not, affect the retail investors, so to say, to get into the market very fast, to get the good gains, as many can be swayed away. So, Mr. Bagga, some point of caution for the small investors, because we are the broadcaster which are reaching to most of the vulnerable class of the society. Some thoughts for those small investors, sir.
Good point. While all this good news we are emphasizing on, markets move in cycles. So we have seen a one-way cycle since March 2020, post the start of COVID, when markets fell very sharply. And most of the investors, 70% of investors today sitting in the markets are post-March 2020. So they have not seen a sustained downturn. That comes. A downturn always comes in the markets and no one can predict. But what helps is that if you stay invested in quality companies in a very broad-based, diversified portfolio for very long periods of time, 5 to 10 years, you don't lose money. So what the Indian retail public is doing, that 23,000 crores a month that they are putting in mutual fund, SIPs, which is systematic investment plan. So 1,000, 2,000 rupees a month, they are going on putting. Put fixed amounts of funds that you can afford every month and then just leave them. Let them lie there. This market, BSE Sensex in 1979 was 100. Today we are at 80,000. That is the kind of return. People like me, Mr. Mishra, have been very fortunate. I was born at the right time. I have seen a market go up 100 times. The Sensex, I have actually seen in my lifetime a Sensex of 100 go to 10,000 and then 8 times. It won't go another 100 times from 10,000, but I was old enough to be working and I've seen a market, not a company. Companies go 1,000 times also, but markets very rarely give you 100-time returns. Indian market has done that. It will give you very good returns. Have a 10 to 12% very nominal expectation. Stay invested for the long time and you will be very pleasantly surprised. And no panic. because the India story is just starting. Remember, Professor Angus Madison of OECD, he made a study of all countries across the world from 0 AD till 1700 and then 1900. Till 1700, we were the biggest economy in the world. We used to be 25% of global GDP. China was 20. US was a frontier market, not even emerging market. It was 1%. US was not there. It was the Native Americans who were there. So Europe peaked in 1870 at 40%. We have just started our journey. But the next 100 years are the Asian century. And as China sunsets, India is emerging. We will go back to that 20%, 25% of global GDP. It's a historical mean reversion. Nothing major is happening. What was our place in the sun is coming back of 300 years of colonialism, disjointed it, but we are coming back. So just remember that when you're investing, invest for the long term, invest in quality. If possible, invest through mutual funds and institutional players rather than trying yourself, because trying yourself, we are not having the training or the time to manage it. So,
So all in all, a great time to be part of India's growth story. I would like to thank both of you gentlemen, Ajay Mishra, Ajay Baggaji, for shedding such valuable insight on, of course, investments for sure, but India's growth story at large. Thank you very much, gentlemen.